So last Friday, we saw the release of the June jobs report, and the question is, does it point towards a possible Fed rate reduction in September? Well, all signs point to better be. In today's video, we are going to break it down and talk a little bit about what this means for the economy and employment. And if you take a moment right now, I'm going to ask you for a favor, and that is going to be pause this video, scroll down to the comment section, and tell us whether or not you think there's going to be a rate cut in September. All right, welcome back. I'm Nancy from Nancy Chu Homes, and let's get started. So June brings us a number of 206,000 jobs created. Now, this is a drop from May, which had 272,000, right? And simultaneously, we saw unemployment go from 4% in May to 4.1% in June. Now, do we think this is a big deal? Not yet, but definitely a sign of slowing economic growth in the country. And that's definitely something to keep an eye out for sure, but I don't think we're in any danger yet. Now, of course, you have to understand that this is something that everyone's been waiting for, right? This feels like the right direction to set up with the Fed for a rate reduction in September. Remember, the Federal Reserve has two mandates: A, tame inflation, and B, balance it with a healthy job market. And do they believe that they have to do these three things to tame inflation? Yes. Number one, raise rates. Number two, slow job growth. As you can see, the unemployment numbers are up and the new job creation is down. So that seems to be working. They've been consistently, doing a pretty good job with that. And the third thing, which is actually the most important one right now, is slow wage growth. So I believe wage growth in May was 4.1%, and as of June, it dropped to 3.9%, right? So we're seeing wage growth, salary growth slow down as well. Now, truly at this point, I think this is the key. A sign that points to inflation essentially starting to ease. I think the Fed is essentially looking for sustained wage growth slowdown in order to be able to comfortably drop rates in September. Now, the question is really, how does this all work, right? It's kind of like supply and demand, except this is all about available jobs and talent to fill those available jobs. So the more jobs that are created, the more worker mobility, right, you have. And then this, of course, means higher salaries. When workers have more jobs to choose from, they can ask for more money, right? The less jobs to go around, then talent definitely is a little more stuck, and they're much less mobile, and they don't have as much of an ability to command higher wages. So this is why the Fed is looking to slow down job creation, because it in turn slows down wage growth, and therefore theoretically tamps down inflation, because people will have less money to spend on goods and services. So prices for these said goods and services have to stop increasing, right? Which in turn slows down inflation. You can see how this hermeneutic argument goes, right? Now, the hard part of all of this is the balancing act. Like, how long do you keep rates elevated in order to do this? The Fed is a pretty blunt instrument. This is really the only tool they have to control these things. So they are having no problems exercising this tool right now. But how long is too long, right? I approach this question with some caution, because jobs always feel like lagging data. And if you push on this current monetary policy for too long, is it possible that we'll feel the repercussions 6 months from now, right? And by then it's too late. We've already squandered our soft landing and we're knee deep in a recession. And then we'd have to climb our way back out of that again. And we all know what that means. That means further rate reductions, and then potential inflation. And oh goodness, the cycle starts all over again. Okay, so let's just hope that the Federal Reserve reads the tea leaves correctly and they make that rate cut in September. I think we all need it at this point. All right, thank you so much. And if you think our videos are valuable for others, please like, comment, subscribe so that we can continue sharing information with everybody. Thank you so much. See you guys next week.